Hi, I'm Flammer from Boston University. In this video, I provide a snapshot of my work with Bansal from Western University entitled Does a Long-Term Orientation Create Value? Evidence from a Regression Discontinuity. The recent financial and economic crisis triggered a radical rethinking among many leading companies who started shifting away from meeting short-term expectations towards longer-term goals. For example, Jack Welch, former CEO of GE, said that, on the face of it, shareholder value is the dumbest idea in the world. Shareholder value is a result, not a strategy. Short-term profits should be aligned with an increase in the long-term value of a company. Yet, it turns out that the majority of companies continue to meeting short-term expectations, even if doing so prevents them from pursuing long-term projects. And perhaps the most striking evidence is provided by a recent survey that finds that 78% of surveyed executives would sacrifice projects with positive net present value if pursuing them would prevent them from meeting short-term expectations. And so it seems that the business world is fairly obsessed with the short term. And this leads us to the question of whether companies would actually benefit from adopting a longer time horizon. This is the key question in our paper. Do companies benefit from adopting a longer-term orientation? This question is intriguing since, on one hand, long-term orientation is often claimed to be value-enhancing, yet companies tend to be short-term focused. So there seems to be a tension between these two. In a nutshell, our main theoretical prediction is that the adoption of longer time horizons increases firm value as it helps counteract the myopic tendencies of the management team. More specifically, managers might be overly concerned about short-term performance due to, for example, career concerns and quarterly earnings expectations. As a result, shareholders face a time-based agency conflict since managers have a higher discount rate than shareholders and hence don't act in their best interest. Now, by providing long-term incentives, shareholders can align managers' interests with long-term value creation. And this leads us to our main hypothesis, namely, an exogenous increase in long-term incentives leads to an increase in firm value. Now, from an empirical perspective, this question of whether companies benefit from adopting a long-term orientation is very difficult to answer for two reasons. First, long-term orientation is not observable. And second, even if you have some empirical measure of long-term orientation, you will have the problem that long-term orientation is endogenous with respect to performance. I mean, if you regress performance on long-term orientation, you will face the issue that long-term orientation is endogenous with respect to performance, since there could be omitted variables that are driving a spurious relationship between the two. For example, it could be that we simply have a deep pocket story where more profitable companies, well, they can easily afford to take a longer-term perspective without being too concerned about the short term. Or it could be that more talented CEOs, they tend to take a long-term perspective, while at the same time their companies perform better given their managerial talent. So as you can see, finding a correlation between performance and long-term orientation does not allow us to make a causal statement. So then the question is, how do we get closer to causality? Well, to fix ideas, I think it's always helpful to think about the ideal experiment. Let's assume we have company A and company B. Ideally, what we would love to have is a random assignment of long-term orientation to companies. So let's assume, for random reasons, company A is assigned with long-term orientation, while for random reasons, company B is assigned with short-term orientation. Then we would look at shareholder value and operating performance, and if these turn out to be higher for company A, then this would indicate that indeed long-term orientation is beneficial to companies. Now, of course, this ideal experiment is not going to happen. Clearly, there's no way we can approach CEOs and ask them to randomize their time horizon. Instead, what we do in this paper is we use an empirical setting that is very close in spirit to this ideal experiment. Specifically, we study shareholder proposals on long-term executive compensation, namely restricted stocks, restricted stock options, and long-term incentive plans. The idea being that long-term compensation provides long-term incentives and hence fosters a longer-term orientation. And then, to obtain a quasi-random assignment of long-term orientation to companies, we look at proposals that pass or fail by a very small margin of votes. Intuitively, whether a proposal is marginally accepted by, let's say, 50.1% of votes or marginally rejected by, say, 49.9% of votes, this is pretty much random. However, this minor difference in vote shares leads to a discrete change, meaning a discontinuity in the adoption of long-term compensation policies. And so the passage of such close-call proposal is pretty much like a random assignment of long-term incentives to companies that allows us to obtain a clean causal estimate. Now, let me briefly illustrate the RDD methodology. The objective of the RDD is to measure the difference in the outcome variable y, for example, the change in firm value around the maturity threshold. So, here on the vertical axis we have the outcome variable y, and on the horizontal axis we have the vote share with the maturity threshold at 50%. So, in order to measure the difference in the outcome variable y around the maturity threshold, what we could do is we could compute the mean of y just below the threshold, the mean of y just above the threshold, and then we could compute the difference between these two. This would provide us with a consistent estimate of the effect of adopting a close-call proposal on the outcome variable. Now, while this provides us with a consistent estimate, it's not the most efficient estimator since we discard a lot of information, namely all non-close call proposals. To obtain a more efficient estimator, the common practice in the economics literature is to fit the polynomial on the left and right-hand side of the threshold, and then the difference between these two polynomials at the threshold provides us with a consistent and efficient estimate of the effect of adopting a close call proposal. Using this regression discontinuity approach, we find that firms that adopt long-term executive compensation policies show a significant increase in their stock market performance, suggesting that long-term rotation is value enhancing. Importantly, these findings also suggest that long-term incentives help mitigate a time-based agency conflict and align managers' interests with long-term value creation. We also find that the adoption of a longer-term orientation leads to higher profits in the long run. And finally, we find that firms increase their engagement in innovation and stakeholder relations. So overall, these findings clearly show that corporate short-termism is hampering business success. In other words, absent long-term incentives, executives tend to underinvest in long-term projects, hurting companies, investors, society, and the natural environment. Moreover, these findings have relevant policy implications as they can inform reforms on executive compensation. Thank you very much for watching this video abstract. If you have any questions, please feel welcome to contact us. Thank you.